Hey guys, in this episode, I'm going to cover whether you should fix your home loan right now or whether you should keep them variable, whether you're an investor or your own occupier, whether you own your own home and that's where you have your home loan, or whether you're an investor and this is a rental property and you have a home loan. Should you fix now? Is this a really good time to fix your loan? Or should you keep it variable? We'll go through the pros and cons. Let's start with the cons of fixing. So the biggest con or downside of fixing your home loan, you can fix it for 1 year, 2 years, 3 years, 4 years, 5 years, which basically says to the bank, hey, the interest rate that you're giving me, that's not going to change over this period of time. And you can decide what that period of time is. Some banks can even let you fix for 5+ years. So that gives you surety, right? But the downside is that in that time with the same bank, you cannot refinance. Let's say that property, if it's your own property, your home, it goes up, let's say it doubles, right? Or even 50% up, it goes up. And at that point in time, you're like, you know what? I've got so much untapped potential. I want to take that equity out, maybe take out 50,000, 100,000, 200,000, 300,000. I want to start investing in real estate, or I want to use that equity for something else. I want to invest it in stocks, or not that I recommend this, buy a motorbike or jet ski or travel around the world. They're not going to let you do that if it is a fixed home loan, because they're saying, no, we just signed a contract that you will pay us this exact same rate and you cannot touch the loan. So with a lot of cases, that same bank will not let you refinance. Other banks will also not let you refinance because your bank will not release it. There are some instances where the bank will allow you to refinance, but there are penalties. In most cases, they will not let you do it unless you pay a massive penalty. So let's say you want to take equity out. They might say, look, you can do that, but here's our fee chart. And to do that, you need to give us, depending on how long it was fixed for, you might need to give them $10,000, $15,000 for the right to break that contract and have access to your money, refinance the loan. So if you're a principal place of residence owner and that was your home loan, of course, if you're an investor, you want to multiply your portfolio. And if you fix, then the real chances are, especially if you know what you're doing and you've located the right investments, let's say like right now, they are in good areas of regional Victoria and Queensland, parts of Brisbane, maybe 1 or 2 pockets of Sydney, maybe some areas in South Australia and WA. You know that there's markets within markets. You know that this year, next year, you're going to make 10 to 20 to 30% growth, and that 300K property is going to become 450, that 500K properties become 750. But if you fixed your rate, you can't take that growth. You can't go to the bank in all cases without penalties, without other encumbrances and say, look, I want that money to be able to buy other investment properties. They won't let you, definitely not. Other banks, the same lender might, but there are fees and charges involved for you breaking that contract. So that's one of the biggest downsides of fixing. You just don't have that flexibility to continue to scale your portfolio or start to scale it for that matter. The second downside of fixing your rate is, what if interest rates drop? Now we're expecting, quietly confident, I think most analysts are expecting that there's a series of rate cuts on the agenda. May not be like 6 or 7, but certainly some rate cuts are on the agenda in the next 12 to 18 months. So if you fix right now, yes, it gives you surety, but you're thinking you might be in this case where in 6 months' time, maybe interest rates have gone down twice. In 18 months' time, maybe interest rates have gone down like 1.5%. And now you're this person who's stuck on higher rates, and all your friends who had just entered the market are getting much more competitive rates than you, or those that were on variable. It's almost like the opposite of what happened in 2020, 2021, when people fixed their rates at 1% or 2%, And those that were on variable, they saw a huge rise to 5%, 6%, etc. It's the opposite dynamic. So given where we are at in the interest rate cycle right now, of course anything can happen, no one can predict the future, but chances are that monetary policy is going to continue to ease. After this, it will continue. We'll continue to see global federal banks, or the Fed, I should say, the RBA, etc., continue to cut rates surely, but slowly. And so that means that fixing comes with its own. It's a high risk play. You're basically a counter-cyclical play. You're saying that no, I really believe that the economy is not as strong as what people say. I really believe that. Actually, I misspoke. I really believe that the economy is super strong, okay, and that unemployment isn't going to rise, that underemployment isn't rising, and that there's no need for rate cuts, and that all these banks, especially the RBA, has completely miscalculated, and actually dropping rates will see the economy surge too much. So it's a counter-cyclical play, and you know what? Sometimes those who make these counter-cyclical plays make the most money because they go against what everyone else says, and that's where the arbitrage is. But look, you have to be a brave person to say that right now in this environment. The third downside of fixing your rate is that you can't extend your interest-only period within that fixed period. Let me explain. So interest only means that you're only paying the bank the interest component on that property. We like it, not in all cases, but we love this strategy. In fact, I used it for many, many years, actually, almost a decade, whereby I could continue to extend my interest-only period with the same bank, with different banks. Therefore, I'm accumulating assets, but at the same time, they're all positive cash flow. They're all paying for themselves: maintenance, council rates, land tax, not mortgage, interest. They're all paying for itself because I'm only paying the interest-only component, and the rent covers that. And that allows it not to hurt my household budget. That allows me to buy 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, etc. properties, and let those properties ripen, let them mature like a fruit on a tree, and all of a sudden your wealth doubles at 3x's, at 4x's, whilst not costing anything or much at all to hold. That's the interest-only policy in a nutshell. Now, if you're on a fixed period, you can't extend that interest-only period. So that means that, let's say you have 2 loans on an interest-only period, and they're all due for extension. Now, if they're due for extension during a period in which you've fixed your loan, you can't extend it on an interest-only period. You have to go principal and interest, which then all of a sudden might be a shock to your financial system. It might be a shock to your finances, your household budget, especially if you were like me and you had, let's say, 9, 10, 11 properties, etc. If they're all or many of them are interest only, and all of a sudden you have to switch over to principal and interest because that interest-only period expired within a fixed interest band, then you might be in a world of trouble. Okay, this is why lending strategy is so important. To plan your portfolio, it's not just, strategy doesn't mean where should I buy, what should I buy. Strategy means organizing and planning your portfolio with all of this in mind, especially lending and when things expire, when they don't expire. So I've used fixed rates as well, but strategically, so it keeps my portfolio flexible, and it allows me to mitigate any shocks to my financial system. Okay, there's no right or wrong. It depends on what's right for you in that time and in the future, according to what goal you're trying to achieve. Now, the last downside of going fixed is that you can't have an offset account in a fixed period loan or a fixed interest loan. So what does that mean? It means that, if you don't have an offset account, you might be having all this cash in a bank. So let me explain what an offset account is. An offset account means, let's say you've got a loan of 200K and you've got cash in the bank of 200K. If you put that 200K cash in an offset account that's tied to the loan account, then you're not paying any interest. You could go 30 years, hypothetically, without paying a single dime of interest on that loan. So it's a free loan, okay? Because you've offset it with the same amount of cash or asset, liquid asset in that way. So if you are someone who has maxed out their property portfolio, let's say you don't have any more borrowing capacity, or you just don't need more properties, you're ready, you're letting the passive income come, you're consolidating, you might have $100,000, $200,000, $300,000, $400,000 in cash because of your PAYG or business or anything like that, and you might be thinking, should I go for a fixed period loan, a fixed interest loan, as opposed to variable? Keep in mind, if it's fixed, most banks won't allow you to have an offset facility. So you'll be making all these interest repayments where you didn't need to because you had this cash that could have offset that loan amount anyway. So in that way, I feel that fixed period loans or fixed interest loans, they're a real detriment if you are cash rich in that way. So hopefully this is making sense. But of course, there's pros to having a fixed period loan. And one of the pros is, let's say you fix it for 1 year, 2 years, 3 years, 4 years. You know exactly how much you're going to pay every single month, every single year. And so for planning purposes, for surety, if you have low risk appetite, it's a boon. You and your partner can exactly know how much you have to budget for month after month, year after year, regardless of Trump, no Trump, regardless of recession, no recession, regardless of boom, no boom, employment, no employment, all these sorts of things. So that's a pro. And the other pro is that sometimes the fixed period loans or fixed interest loans, they're a little bit cheaper. Not all the time, but right now I know that some lenders, some banks, the interest rate that you get on a fixed loan is slightly cheaper than on a variable loan, because they're trying to entice you to go fixed, because they know in the back of their economic mind that interest rates are likely to come down a lot. So they're putting the carrot out there. They're saying, this is completely hypothetical. They're saying, look, variable, you can get 6%, fixed will give you 5.5%. Take it for 5 years. And they know that in 5 years' time, or let's say 2 years' time, the variable rate's going to come down more than that anyway. And then on net, the bank will win. The house always wins in that way. So that's also a pro, that you might get a lower rate, but just keep in mind that, the house is giving you that cheaper fixed period, the fixed interest rate, maybe for some reason, and try to understand the background. So hopefully that makes sense. A lot of you have asked for this episode. Most of the time, it makes sense to stay variable. You can also choose a percentage. So you might be thinking, PK, there's so many opposing forces, it's hard to decide. You can also take a loan and say, I want 50% fixed, 50% variable. Of course, if you start doing that across huge portfolio sizes, let's say 10 properties, and you choose one at 30-70, another at 60-40, another at 90-10, then you've got, all of a sudden, you'll get all these different accounts you have to manage, because every time you split it like that, there's a different account for each split, and that becomes a bit of a logistical nightmare. But it is an option for you to hedge your bets and say, all right, I made the wrong decision, but at least I have 50% of this where I can go ahead and get equity, or I have been able to beat the market, beat the bank, beat the house in my forecast of where interest rates will go. I'll stop it there. Hopefully that brought you value. Hit the subscribe button, give it a thumbs up. And I just want to say thank you for being part of this community. I really enjoy bringing you this type of content and bringing you a lot of value so that you can genuinely improve your financial situation. I know it's tough. It's really tough for a lot of people. They're looking for the panacea. How can I get out of this? How can I beat the system? How can I escape the rat race? Get out of the 9 to 5. It's through small nuggets of gold, consuming this type of content. If you do this day after day, hour after hour, week after week, you'll be amazed at how knowledgeable you become after 1 month, 2 months, 3 months, and what you can achieve with that knowledge. because it's, those who are truly wealthy, truly rich, they don't follow what most other people do. Thanks, guys.